The Bank of Canada just announced a 50 basis point rate cut, bringing the policy rate down to 3.25. This isn't just a policy shift. It's the clearest signal yet that the Canadian economy is in serious trouble. For months, economists predicted we'd settle around a 3% rate, and now we're nearly there. But the real story isn't this cut, it's what comes next. The bank's decisions will now be driven by events, and the picture isn't looking good. Here's what's happening in BC and across the country. Unemployment is climbing as the economy slows. Residential construction is in free fall, especially in BC and Ontario. Housing starts are hitting decade lows. Personal and small business insolvencies are rising with no relief in sight. Consumer debt is at record highs as households struggle to make ends meet. At this point, there's no clear sign of improvement on the horizon. Manufacturing is in decline, small businesses are struggling to survive, and the real estate market, particularly in urban condo sectors, is under immense pressure. So what does this mean for BC? It's good news for those with variable rate mortgages, as further cuts are almost certain. Expect another rate drop on January 29th and possibly 2 more after that. But the broader picture is bleak. Construction jobs are vanishing, consumer spending is tightening, and businesses are failing. The Bank of Canada is cutting rates because it has no other choice. The economic data leaves no room for optimism. This rate cut may provide some temporary relief for borrowers, but it's a stark reminder of the challenges ahead for BC's economy and beyond. The question is, what happens when rate cuts are no longer enough?